There's a huge amount of things this fall to worry about, not the least of which is an election in another month here in the U.S. But my view hasn't changed. I still think we're in the latter stages of a 42-year secular bull market that started in August of 1982. It's been an amazing run, and particularly this last since October 2022, it keeps going. You get these pullbacks, but I think it's going higher. The economy, surprisingly, is resilient. I mean, as you know, probably for most of this year, there's been concern that the economy was heading south and that it would not stay up, and therefore the market wouldn't go up. And yet here we are in the estimate for the third quarter now. Looks like it's 3% or above. May surprise and come in lower than that. But I've been one of those that's been saying we could even be in recession now. And surprisingly, in spite of what GDP is pointing to right now, the way revisions come in, they've just revised upward. And because we have a have and have not economy, at the very least, a big chunk of the economy is already in recession. Whether statistically we're at 3% GDP or whether that's going to get revised down, I don't know. But you're still looking at an economy where the top end is doing very well, but there's signs of slowing, and where the bottom end is struggling just to meet their basic needs. And that tells me we're continuing to move towards trouble. But that being said, the economy is still doing fairly well from a statistical standpoint, and allows Wall Street and investors to say we're looking at a soft landing. So from that perspective, it's quite positive, because what we've had is 2.5 years of tightening and basically 4 years since the last rate cut. And yet we have an economy still chugging along. So it looks like Jay Powell and his crew performed the miracle, and basically what they needed to take care of to get inflation down to their target or close to it without sacrificing the economy. If he does that, that's beyond most people's expectations. And for at least for now, and I think through this fall, maybe through this year, that's going to be the story. I think that's the narrative, is that you have a Fed that now says we can ease because we're, number one, way behind the market. Based on market rates, the Fed could still cut rates another 150 basis points, and they just cut 50, so they were really almost 200 basis points behind the market. So you have a case where the Fed should be in ease mode, and are. Yes, they're trying to kind of slow expectations here and say, based on Powell's most recent talk, he's trying to say, hey, don't expect 50 every time. We did a big start, we may move down. He's not telegraphing what the next move is going to be, but he's just cautioning the markets not to get ahead of themselves. So I think we're in ease mode for sure. Whether we get another 100 basis points this year or whether we only get 50 or 75 doesn't really matter, because the bond market is basically in charge of rates. The Fed's following, the bond market is leading. And my view is the bond market is nearing the end of a short-term correction, and that ultimately you'll see in the next month or month and a half, the 10-year move down to 3.25. And by the end of the year, early next year, you could see the 10-year down to 2.5. That doesn't tell you have a strong economy. I think what you have is an economy that's going to slow, and ultimately I think next year is a rough year. I think people get confused because they think bond market means smart investors see things before the Federal Reserve chairman sees them. Or, it's not smart investors. It's a law of large numbers. The market in its aggregate is discounting all the information out there, and its efficiencies will put it all together. No one person, no AI. It's just the way the market has always worked. It's able, with all investors, with all their thoughts, will ultimately generate, an answer in the market that is telling you at any given point what they see. And so it's not just futures trying to decide what the next Fed cut is going to be. I'm not talking about that. I'm really talking about market rates, 10-year rates, for example, 2-year rates. Because they're large markets and because there are so many people with so many different diverse opinions out there, it kind of gets boiled down into any given day what the rate is. And 9 months ago or more, we were at 5% on the 10-year. We're now 480 up from 460 380 up from 360 not long ago. So it's dropped, it dropped 140 basis points now, 120 basis points. And, the Fed just began its rate cutting. It was at close to 5.5, cutting down by a half, so it's down near 5 or just below. So if you're looking at 5% Fed funds rate and you're looking at 10-year at 380 and 2 years below that, it tells you that the market believes that inflation's been defeated, or at least for the time being is not a problem, and that the economy is not strong. It's above water, but it's weakening. And there are lots of indicators that you can point to, whether it be ISMs, whether it be housing rolling over, whether it be consumer delinquencies on credit cards, and whether it be bank loans. There are a lot of things out there that say this is not a strong economy. It's an economy that's starting to run into obstacles. Every cycle, the Fed tends to be slow on both tightening and on the easing because they're looking at data that's by definition backward looking, and because even more than that, in this case, their mandate includes looking at jobs, and jobs that are a lagging indicator. So not only are they looking at information that's a month old or more, but they're also looking at something that really, it could be several months lag to what is really happening. So by definition, they're going to be slow and late. My concern is that this time, more than in most cycles, we have such big leverage in the system. Leverage, as I define, by 320 trillion in global debt, 35 trillion in U.S. government debt, way beyond anything we've ever seen in any previous cycle. And leverage as defined by derivatives, which I define as leverage on markets, which are in the area of quadrillions in terms of notional value. And so those are things that are way beyond even 2008-9 when we were very highly leveraged. If you have that kind of leverage, that means you have tremendous risk in the system. That means if you make a policy mistake or you're late, the price you pay for that mistake or for being late tends to be outsized. And if 2008-9 was the biggest reaction to that case that we have seen in the post-World War II era, I argue that this time, with leverage way beyond even that time, I think the odds are that the reaction in the economy and in the markets is going to be even far bigger. Labor is a lagging indicator. So they are behind the curve when they finally react to it. And it's going to take many months of ease to have an impact. It can impact the markets pretty quickly, but the economy, it doesn't impact for many months. So in the meantime, you're going to have labor or unemployment to tick up. I have a forecast for next year because of my dire forecast for the global economy that we could even see double-digit unemployment next year. We need to step back and understand. Historically, 4 or 4.5% unemployment was always viewed as full employment. It's quite low historically. That being said, because of what happened in the pandemic and even before, there are a lot of people out there who aren't in the employment figures because they stopped looking. They got discouraged, or they're living in a period where they have several part-time jobs that don't reach the levels of their income prior to that. So the numbers are crude at best in terms of telling you how people are doing. What happens, unfortunately, is you've got a whole trading mentality out there in the marketplace, and algos certainly add to that, but retail and institutional both are judging things on a day-to-day basis on the input you get every day. I call it the noise because I think it's trends that matter, not the day-to-day, week-to-week, month-to-month numbers. But the problem, you're in every single thing you look at, whether it be markets or indicators, data, it's a stair-step process. It's not a linear thing. So inflation's come down, but it's going to have periods where it has a bounce. There's going to be counter trend moves in everything. So could inflation surprise to the upside? For a few months it could, but frankly, you've had mortgage rates already come down quite a bit. They got up almost to 8% here, and they've come down towards 6.5. It's stimulating some activity out there, but surprisingly not a lot, because you've seen in the past when the rates were moving up, when you got to move down in rates, people came out of the woodwork and said, I better grab this rate before it moves up again. This time around, you're not seeing, but I think you're also seeing a beginning of inventory starting to come out too, because people that were looking to sell are starting to realize I'm not going to be able to pick the top, and if I try to, I might miss the whole thing. So I think housing is not going to be inflationary, I think, going forward. I think we've seen the top in housing, and while you can get a month-to-month bounce in the numbers, ultimately I think housing's headed a lot lower. Oil, I think oil, while you've had this bounce because of what's going on in the Middle East this week, I've been the bear on the street on oil from 130. I mean, I missed the bounce to 130. I was looking for when it was 85 before Russia invaded Ukraine. I said, maybe you can get up to 90, but not much higher. And you have got an overnight move from there to 130. So I missed that week. But from there, I've been right in terms of saying oil's going down, not up. If you remember when we were at 130, the calls were 150 and 200. And I said, no, I think we've seen what we're going to get. I've been bearish ever since. So that was 2.5 years ago. And I've been consistently saying, first I said it can go back to 85. Then when it got down near there, I said, I've been using the term, the low to mid 60s as my target. And we got there, obviously, I don't know, a year and a half ago. And then again, recently, this bounce, I think, is obviously, you can't predict geopolitics and it could disrupt. But if I were betting, I think most of that bounce has already happened. When I look at the charts, I think it's more likely down than up from here. And I believe my 60 target is going to prove true, and I've been saying you could see 60 this year, and I believe you may actually undercut 60 by a few dollars. So next year, I'm calling for a global bust, as you know. That's pretty dire forecast for the global economy. I believe you'll see oil down to $30 in the global bust. So I'm definitely in the deflation camp in terms of oil. So with oil trending down, I think that again is going to keep the inflation trending down, not up.